Have you with us. We're just about 15 minutes away from the start of trading, and it looks like we are going to see weakness at the open today after that rally we saw yesterday. Tariff worries once again on the minds of investors. Art Hogan's the chief market strategist to B. Riley Wealth Management. Art, it's great to have you with us. You've been through a lot of ups and downs in the markets and seen some pretty sharp responses to big news. How would you compare this moment to some of the other moments in your career?
Yeah, I'll tell you this, John, the problem with what we're going through right now is the amount that we don't know and the amount of uncertainty that we have. It seems like we keep moving the goalpost on policy and certainly tariffs, and it's hard to know what the end goal is here. And I certainly think at the beginning of this new administration, there had been some assumptions that we could look back to the 2018 tariff trade book and see, well, there was a lot of talk about tariffs, but at the end of the day, they were applied much more surgically and not universally. And at the same time, John, you had a tax cut that just went in 2017. So there was a fiscal response in front of tariffs and the trade wars. And that gave corporations some cushion. And we also had inflation that was below 2% at the time. So we're in a completely different place now. Flash forward to the last week or two, and you've got tariffs that are being applied universally, and certainly inflation that's above 2% and closer to 3%, and there's no fiscal response. We're not going to have a tax cut in front of this trade war. So the response by corporations is going to be either cut margins or raise prices. So we're at a place in time where both corporate leaders and consumers and investors really don't know what the future holds. How long will this last? Will there be any sort of clawback of some of the tariffs that have already been put on? And is there an end game here? And unfortunately, not knowing any of those, it's hard for investors, certainly hard for people running companies, and certainly hard for consumers to really know what to do.
Okay, that's really helpful context as always. At the end of the day, Art, if someone comes up to you and says, "I get it," what does your gut tell you? What should I do with my portfolio right now?
Well, coming into the new year, after having 2 years where the S&P 500 was up north of 20%, it was a good idea to adjust your asset allocation. Certainly, you needed to, at the very most, market weight your technology exposure. That's proven to be the right trade. I certainly think that a bit more defensive in your allocations to equities, and that's proven to be the right direction to be in. Certainly, we've got healthcare as a overweight here, and healthcare is the best performing sector in the S&P 500. I think that you don't want to make massive changes to your long-term portfolio, but you do want to make sure that you're reallocating after a couple of years where technology was the leadership, and that certainly has been the case. You want to bear in mind that this could be a rough ride for the entirety of this year, and if that's the case, the more defensive you are, the better shape you're going to be in.
It's, I got to say, Art, it's unique. I mean, you and I have been talking for years. The relationship between the United States and Canada is very strong, especially through the world of finance. But right now, Canadians are trying to figure out what tariffs mean for businesses here and the economy here. In terms of this strategy by the president to ultimately bring more business to the U.S., is that influencing the kinds of stocks that you'd be recommending? Like you were talking to our producers about small caps in the U.S., companies that are largely domiciled in the U.S. You actually think this is an environment that is favorable to them?
Yeah, small caps have underperformed large caps for the better part of 10 years now, and the gap between small and large cap valuations hasn't been this wide going back to 2000. So that's one of the things, largely domestically focused and sort of agnostic to the strength of the dollar, but also dependent on lower interest rates and steady economic growth. So at the start of the year, it certainly seemed like we were checking all those boxes. There's certainly been a significant bump in the road, and a lot of that where interest rates have certainly come down, but likely because the economy is slowing, and we're starting to see that in economic data. So that's a tough place to be in for small caps. So that was one of the reasons we looked at that. At some point in time, small caps will catch a bid here, but we just don't know in the here and now with rising input costs due to tariffs for a lot of the small cap manufacturers. It's going to be very difficult for them and the S&P 500 to get much traction in the near term. But I certainly think at the end of the day, it's going to be time for small caps. We just need to get through this uncertainty and know exactly where we are, what exactly the end game is for tariffs across the board. forward and to see if there's any possibility that some of these get pulled back. Or can countries like Canada say, here's what we're doing, and get this at least cut in half or perhaps pulled back altogether. And this is an administration that in large part has been known to measure their success by how the market's doing. So at some point in time, I don't know what the threshold for pain will be, but there's certainly going to be a realization that a lot of what they're doing is not just causing short-term pain, but causing economic damage.
Okay. All right. Thanks a lot. Good food for thought as always.